All right, welcome to today's Market Diagnostic Explainer. I'm putting on my technical and fundamental advisor hat today because, frankly, we've got a massive paradox to unpack. The markets threw us a serious curveball, so let's dissect this incredibly volatile session and find out exactly where the smart money is moving right now. Let's get right into it.
So here's the central paradox of this trading day. Global crude oil prices have taken a massive structural hit. I mean, we are talking down 12% in just 3 sessions, with Brent crude actually slipping below that critical $100 per barrel mark. Now, normally, for an oil importing nation like India, this is a huge macro tailwind. It should send the headline index flying. Yet, the Nifty 50 barely flinched today. You really have to ask yourself, why did the large caps hit the snooze button while the macro picture fundamentally improved? Well, you see, under the hood, that quote-unquote sleeping index was pure visceral volatility. We opened with a decent 68-point gap up at 24,399, which makes sense, tracking stable global cues. But then, wow, intense late-morning selling dragged the Nifty all the way down to a low of 24,285. And just as panic was really starting to set in across the board, boom, a sharp, aggressive midday recovery spiked us right back up toward the 24,450 to 24,480 zone. But it just couldn't sustain itself. There was absolutely zero follow-through at higher levels, and we eventually closed almost completely flat at 24,326, down just 4 points. It was a wild roller coaster ride that ended exactly where it started.
To make sense of all this chop, here is our roadmap for today. We're going to start with a tale of two markets, dive deep into fundamentals and global cues, look at the institutional tug-of-war, map out our support and resistance levels, listen in on some management chatter, and finally, prep for the calendar.
All right, let's jump straight into Section 1, a tale of two markets. What we witnessed today was a stark, almost aggressive divergence. On one hand, you have the frustratingly subdued large-cap performance going absolutely nowhere. Actually, scratch that. It wasn't just subdued. The heavyweights were literally anchoring the index down. But on the other hand, look at the mid-caps. The mid-cap sector staged an explosive 1.67% surge, closing at 14,551. I'll tell you right now, this is the widest divergence we have seen in weeks. The market breadth was incredibly strong, with advances outnumbering declines 2-to-1 in the broader Nifty 500. Underneath the surface, a massive rally was playing out.
And you know, what's truly revealing here is who was actually moving. The momentum definitely wasn't in your standard index heavyweights, it was concentrated way further down the ladder. Look at this. Godrej Industries put on a spectacular show, surging an incredible 20%. No way, right? Then you've got Tejas Networks up nearly 15%, Craftsman up over 12%. This proves without a shadow of a doubt that smart money is aggressively hunting for value and growth in the mid and small cap spaces, all while keeping large caps on a very tight leash. Moving right along to Section 2, Fundamentals and Global Cues. Now, as a fundamental advisor, I literally cannot stress enough how crucial this next part is. Notice the commodities board today. Crude oil crashing another 3.08% to 8,739 rupees. Cheaper crude is a structural positive for India. It's a game changer. And you can see the immediate ripple effect right there in the currency market. Because crude is cheaper, our dollar outflow drops, which directly filters through to strengthen the Indian rupee. We saw it rebound nicely by 0.19% to 94.30 against the dollar today. Bond yields are calm, so despite the market chop, the macro foundation right now is actually quite solid. And here's the best part. That solid macro foundation, it is being heavily backed up by real, tangible corporate performance. Just look at these fundamental drivers hitting the wire. MRF Limited reported a massive 37% year-on-year jump in their Q4 standalone profit. Paytm reported a complete turnaround, posting a consolidated profit of 183 crore rupees compared to a heavy loss last year. And honestly, my favorite piece of news today, Royal Enfield committing an aggressive 2,200 crore rupee investment for a brand new manufacturing facility in Andhra Pradesh. That's going to add nearly 9 lakh units of capacity. This is real, on-the-ground growth, folks.
Okay, let's peel back the layers in Section 3, the institutional tug-of-war.
So, where is all this intraday volatility actually stemming from? It's from an intense battle happening right now between the big boys. Today alone, foreign institutional investors dumped a massive 5,835 crore rupees worth of equities. That is heavy, relentless selling pressure. But that relentless selling was completely absorbed, and then some, by aggressive domestic institutional buying to the tune of 6,837 crore rupees. I mean, this is the absolute definition of a tug of war.
And listen, this wasn't just a one-off. Look at the 5-day trend. It shows that every single day, FIIs are booking profits and pulling money out. And every single day, the domestic institutions, heavily backed by retail systematic investment plans, are stepping right in with confident buy orders. Domestic money is single-handedly holding this market up and preventing a broader collapse despite heavy foreign outflows. It is a major structural shift in who actually controls the Indian markets right now.
Time to get technical in Section 4, Mapping Support and Resistance.
All right, the crucial point is right here on the open interest chart for the upcoming May 12th expiry. To break it down simply, the red bars you see represent call writing. These are the bears creating resistance ceilings. The green bars are put writing, the bulls building support floors. In a crazy volatile market like this data right here, this is your true roadmap. So distilling that options data down for you, here are the clear, actionable battle lines you need to mark for tomorrow's session. The maximum call open interest is clustered heavily at 24,500. That is our strong ceiling. Every time we approach that level, expect sellers to pounce, exactly like they did midday today. On the flip side, the maximum put open interest is sitting like a rock-solid floor at 24,000. We also have a strong secondary support building up around 24,200. Basically, we are boxed in right now between 24,200 and 24,500. Keep these tactical levels locked in your mind for tomorrow.
Let's shift gears for Section 5, Management Chatter. Let's hear straight from the corporate leaders. First up, we have Reliance Industries commenting on their massive new energy vertical. Karan Suri, their Senior VP of New Energy, noted the signing of one of the world's largest green ammonia supply contracts with Samsung C&T. He stated this effectively demonstrates the confidence off-takers have in their integrated green energy ecosystem. Guys, this is a massive structural signal. They aren't just building plants, they are locking in global-scale long-term contracts.
And on the consumption side, Varun Beverages offered a really fascinating insight into changing consumer habits. They noted that low-sugar and no-sugar products have now jumped to roughly 63% of their total sales volume. That's huge, but here is the absolutely critical part for us as investors. Despite an inflationary input environment, their gross margins actually improved by 62 basis points. Talk about a real flex. Companies with strong pricing power are adapting to consumer trends and protecting their margins simultaneously.
Finally, Section 6, Looking ahead at the calendar.
So, what's on the docket for tomorrow's action? Well, keep a very close eye on a slew of dividend X-dates hitting the market, including Sundram Fasteners, So Many Ceramics, and Loris Labs. The earnings calendar also remains pretty heavy, with major Q4 results coming from heavy hitters like ABB India and Blue Dart Express. Expect some serious stock-specific volatility around these names as the market digests their numbers against the broader macro backdrop we've been discussing today.
Which brings us to the final, and honestly, the most crucial question I want to leave you with today. We've seen a structural drop in crude, we've seen DIIs aggressively buying the dips, and we've seen mid-caps absolutely surging while the headline index sleeps. But can this explosive mid-cap rally genuinely sustain itself or take the Nifty higher without the eventual return of FII participation? Or are our domestic funds powerful enough to drive this entire market solo? It is the ultimate question going into tomorrow's session. Thank you so much for joining me for this Market Diagnostic Explainer. Let me know your thoughts on this epic FII versus DII battle, and I'll catch you in the next one.